This video is based on Wouter J. Keller's paper, Lazy Momentum with Growth Trend Timing, Resilient Asset Allocation, available on SSRN. I'm going to translate the strategy into plain English, what you hold, what signals you check each month, when you go risk on versus risk off, and how it did in the author's long backtest. This is for education, not financial advice, and backtests can look great on paper and still disappoint in real life. Here's the hook. Each RAA tries to avoid the classic mistake of jumping in and out too often. Instead, it stays invested in a diversified portfolio most months. Then, it only hits the brakes when two separate warning systems agree. Think of it like driving. You don't slam the brakes because the sky looks cloudy. You slow down when the road is icy and your traction control light comes on. The risk-on portfolio is simple. 5 assets, equal weighted, so 20% each. 2 are equities with different flavors. QQQ leans toward growth and tech, while IWN leans towards small cap value, improving diversification versus holding overlapping large cap stock funds. Then you've got 2 treasury bond funds, intermediate and long duration, and a gold allocation. It's intentionally built to be more all-weather, meaning it's not betting everything on one economic outcome. When the strategy turns defensive, it doesn't go to literal cash. In this paper, cash means treasuries. The risk-off portfolio is just IEF and TLT at 50-50. That choice is practical, since IEF and TLT already exist inside the risk-on portfolio. Switching modes usually means selling the equity and gold sleeves and shifting into more treasuries, reducing complexity and potentially turnover. The first gate is unemployment. RAA uses the US unemployment rate from Fred, importantly with a 1-month delay because that's how real investors experience the data. The rule is intentionally slow and simple. Compare the latest available unemployment rate to the rate from 12 months earlier. If unemployment is higher than a year ago, that's a bearish unemployment trend. This filter is trying to capture the economy is deteriorating without overreacting to one weird month. Only if unemployment is already flashing warning does RAA look at the market's canaries. In the paper, the canaries are VWO and BND. Why those? The idea is they can show stress earlier than a big US index might. The trend method is a fast momentum blend called 13612W, combining 1, 3, 6, and 12-month returns with heavier weight on the most recent months. And here's the key. The market trend turns bearish if at least one canary turns bearish. That one-strike rule is what makes the crash protection faster. This is the whole playbook. Every month end, you ask, is unemployment worse than it was a year ago? If not, stay in the diversified 5-asset portfolio. If yes, you then ask, are markets showing stress through the canaries? If unemployment is worsening and at least one canary trend is bearish, you switch into the treasury-only defensive mix. Otherwise, you stay risk-on. 2 filters, 1 action. And because the unemployment filter is slow, the strategy doesn't flip-flop constantly. Now, the results, as reported in the paper. Over the full sample from 1970 to 2020, the final RAA rule set shows about 12.3% annualized return with an 11.8% maximum monthly drawdown and about 8.9% volatility. The strategy was in its defensive treasury stance about 15.5% of the time, so most months it stayed invested in the 5-asset mix. The author also notes it's lazy in practice, roughly 1 trading month per year on average. For comparison, the paper lists a classic 60-40 benchmark around 9.7% CAGR with about 29.5% max drawdown. Here's the intuition. First, the core portfolio isn't a one-trick pony. It blends different return drivers, stocks, bonds of 2 durations, and gold. Second, the timing is designed to be selective. You don't go defensive just because stocks wobble, and you don't go defensive just because unemployment ticks up. You need both economic deterioration and market stress. That dual confirmation idea can reduce false alarms. And when the signal does flip, the defensive sleeve is treasuries, which historically have often helped during major equity drawdowns, though that's not guaranteed in every regime. Operationally, RAA is a once-a-month routine. Update the unemployment number with a 1-month lag, check the canary momentum only if unemployment is worsening, and then hold either the risk-on mix or the risk-off treasuries mix for the next month. The backtest rebalances monthly back to target weights, but the author suggests that rebalancing only when switching regimes, or at least annually, may not change much. Transaction costs in the paper are modeled, but your real-world costs, taxes, spreads, and slippage can be very different. Final note, all of this comes from one research paper and its historical test. The future can break any backtest, especially when inflation, interest rates, or correlations behave differently than the past. So if you're interested, pull the original SSRN paper, review the assumptions and proxies, and consider paper trading the rules before risking real capital.